If you have any suggestions, please write the show. How can you help us, though, continue to help you? First, please subscribe to the channel. Like us. If you listen to the audio version, leave us a 5-star review wherever you can. If you follow our posts, if you see our posts, please share those posts, share the content, and link back to our law firm website, which helps us to continue our SEO marketing and grow our firm and help small business owners. I want to thank you for tuning in. I want to thank you for being a listener, and I want to thank you for staying a listener.
The buying business, especially if you're a senior executive, you cannot communicate too much, because any place where speculation and innuendo is allowed into the process, it just explodes. It's like a wildfire, and you generally can't put it out. Start doing, and that usually gives you the answer to the negative as well.
All right, Cameron, so thanks for joining me. You told me you're in Kansas City, but not the Kansas City, Missouri side. You're in the Kansas side, right? And
that is correct.
You just sent us all the terrible weather we're having in New Jersey, apparently, right?
We did, but there's sunshine coming, Mitch.
We're hoping for it. The weather's been warmer, but it's been, really rainy. Okay. Why don't we start then, with your background, how you got started, maybe some stories about you being in business, and then we'll take a commercial break about midway through. Then we'll talk about Raincatcher and all the business brokering world, because I do a lot of those transactions.
Great. Yeah. Thank you for asking. Well, Mitch, my background as an investment banker now is a pretty unusual path. You don't often see this kind of a path in investment bankers. So I have a degree in journalism from the University of Missouri. I started my career as an advertising copywriter in a small technical trade magazine publishing company.
Okay.
And that was owned by a huge international conglomerate. And about 5 years into my career there, they sold it off to the Macmillan Book Publishing Company.
Okay.
We were at about a $15 million business then. And they said, hey, we kind of like this business. We want you to grow. So they said, go buy companies. It's kind of like taking the proverbial 6-month-old baby, dropping him or her in the pool and saying, swim. Didn't tell us how to do it. They just said, we've got money and you did it.
So you said it was a technical trade magazine for what industry?
Well, we had when I started there, we had about 9 of them, anything from broadcasting, radio and television to agricultural market titles.
Oh, really went through different industries.
Not glamorous, but all very relevant to the professionals in any of those industry sectors.
So then they said at Macmillan, here's money, go out and acquire more publications.
Yes. Yeah. So for better or worse, the very first acquisition we made was one I was responsible for.
Okay.
And bottom line, I screwed it up.
Well, you never acquired a company in your life, right?
No.
They didn't send you to business school and say, learn how to do this, right?
Exactly. Well, again, I was a journalism major. I knew words and stories, but I didn't know this transaction stuff. So thankfully it was a really small deal. Relatively speaking, it was about $1 million acquisition. With your Fortune 100 company, that's peanuts for them.
Right.
But in the course of a year, we pretty much killed the property, and you get a PhD real fast, oftentimes from the mistakes you made. So that really was the foundation for, hey, what do we want to make sure we don't do anymore on future deals?
So were the mistakes more pre-deal during the due diligence phase? Were they post-deal operating the business?
It was a little bit of both, but the critical mistakes were not in doing financial analysis work or.
Okay. It wasn't like something you overlooked and you found out they weren't as profitable as you thought they were or whatever.
Nope. No, It was a people issue.
Okay.
We all thought at that time that it was about the numbers.
Right.
And obviously about the product we were acquiring. Ironically, we're on a podcast, and that particular technical journal was for the audio recording industry back in those days. Was primarily for creating music. Yeah.
Yeah, of course.
But we and I in particular didn't read the people, didn't really understand some of those dynamics and how to integrate that acquisition. And I've actually lectured on it. One of the things we learned over time and that I've seen in other situations is one of the biggest reasons deals fall apart post-closing of the sale is in the integration. So buyers spend 90+% of their time focused on due diligence, contract negotiation, and what price they're going to pay, and very little focus on integration. And then once they own it, the attitude is often, hey, I bought you, you didn't buy me, I'm bigger than you.
Happen. Right.
And this is what's going to happen. It's my way or the highway.
Right. They dictate, they don't lead.
They dictate, they don't lead. They even worse, they don't listen. And they don't understand that there are cultural factors that are different between the businesses, and how do you integrate those?
Right.
And how do you recognize best practices in the business you're acquiring? Because there is a reason you acquired them. So they're doing some things right.
Right.
And how can you make sure you protect those things?
Yeah, I think in the small market, which is where you work, and I do most of my work too, that's what drives, like, the numbers don't exist without the people. And I think that you get a lot of business. I've had this situation where you get sellers, owners of businesses that don't really want to tell their employees what's going on because they're afraid they'll leave and they want to close this deal and make their money. But then the buyer is getting into a situation where these employees are caught off guard, or they're living off of rumors, some of which may not be accurate. And you end up with, change and difficulty, and people leave, and, and it really blows up the whole deal when, I don't know. I don't know. It's a double-edged sword, right? So you don't want these employees to leave because they're vital to the business, but you want to reassure them that their life will still be, because some of these people, that's all it is, right? I mean, it's a job for them, and they pay their livelihood that way, and they get real frightened with change, and people just don't like change. They don't think it's going to be good ever. Yeah. Yeah.
Well, there's a few tactics we learned around that to really address that issue. So first of all, in those situations, you cannot, as the buying business, especially if you're a senior executive, you cannot communicate too much, because any place where speculation and innuendo is allowed into the process, it just explodes. It's like a wildfire, and you generally can't put it out.
Right.
But we learned and adopted a tactic which we found very successful over time. Real simple concept. It is time consuming, depending on the size of the acquisition. Of course, there are some feasibility factors, but we call it start, stop, keep.
Okay.
So we would take at least the senior management and middle level management, and when we could, we would meet with every single employee one-on-one. And we just sit down, get acquainted, to see who I am, who are you, and then we'd say, okay, we're going to do a little exercise here. What would you like to see your company start doing? And that usually gives you the answer to the negative as well.
Right, what you're going to stop.
But employees at all levels see opportunity, and they're not often heard or asked that question. So you oftentimes get great upside opportunities for that very, it's a 15, 20-minute conversation with each employee. Again, it's time consuming, but highly valuable.
Right.
Then you want to make sure, what would you like to make sure that your company keeps on doing? And that's where a lot of the cultural factors that exist that you learn about. And then lastly, what would you like to see the company stop doing? But generally, you already know that answer from the starts and the keeps.
Right.
And I did, as a simple example, I was contracted to do a very complicated turnaround and business transformation on a $60 million 501c3 business.
Sure.
And about 200 employees in that business. And I adopted that tactic when I was brought into the business. And there was a ton of resistance, and it was a very insular corporate culture. And I had some assumptions going into that situation on what kind of radical changes were going to need to be made.
Right.
But by the time I had gone through about 200 of these interviews, I did a 180. Some of the moves I was going to make would have turned out to be extremely detrimental to the business, because they were hardcore keepers for those employees as part of their corporate culture. Got it. I also learned that the cancer in that business was in a completely unanticipated area of the company. So that changed my strategy completely and led to ultimately a very successful transformation. But if I had started off on my base assumptions, we would have gotten in trouble.
Yeah, sure. Well, you want to get the employees to buy into the change. You want them to be on board with the change, and you want them to feel like they have some ownership.
Exactly.
We don't use that strategy, but definitely when the opportunity is there, I encourage clients to, interview all the people. And sometimes you get feedback from, somebody's a kind of a sour apple, or they're really not supportive of the deal, or they're looking to derail it. And it's better that ahead of time. Either you got to incentivize this person to stay because they're a key person. There are companies certainly in the small to mid-market range where they don't have a lot of contracts with their people, their key people. They've been with them a long time. They don't have like a non-compete or whatever. They've never been able to bring it up or never brought it up, never really thought about it. And now this person can just walk down the street and go to a competitor or start up, depending on the business, start up a competing business, and it changes what you're doing. So I think that's good advice to get in there ahead of time and say, hey, first of all, we care about what you have to say. We want this to be successful, and we'd like you to be on board to make it successful as well. They keep their job and maybe make more money if the company's profitable.
Very true. But on the front end, when we're the buyer as opposed to the seller, we're asking the senior management that we're in contact with on the deal who their key people are. And will often, as part of the deal structure, require them to put some kind of a retainer in place or a stay bonus in place for those employees, especially if they're key knowledge holders or critical in customer relationships, for example. And as part of that structure, we ask them to have those folks sign a non-compete agreement, but they're incentivized and paid well for that.
Right.
Because we want them to stay, obviously, in perpetuity, but in a worst case scenario, we want to make sure we have them around for at least a year for knowledge transformation, risk mitigation as the buyer.
Of course.
And that's been a pretty successful formula on most of the deals. Even now, as an investment banker, we counsel our sell-side clients in that same manner.
Of course.
And oftentimes the buyer sees less risk in the deal, and they're willing to either enhance their valuation on the deal or create a less complicated deal structure because they don't need or see the same level of potential risk.
Sure. Well, that is one of the biggest risks, right? The biggest risks are the top 2 or 3 guys walk out the door the day you close. And I've seen it happen with deals that they didn't do proper due diligence and I wasn't involved. And then they're coming and you say, what do? We can't do anything. You didn't give this guy any kind of consideration to sign an agreement. He's got no contracts with the company. He's got no loyalty because the owner's gone. And now your whole deal is, I forget that enhances the value. It reduces the value of the other end of the spectrum, and I think it's a real risky deal. I've done plenty of deals in the $10 to $20 million range where, family owned business. It was always run by the family and somebody's taking it over and they have a couple of key people that really are the biggest assets that they have. The rest of it's inventory and customers, but without those people, that the engine doesn't keep rolling. So that's good advice too. I mean, if somebody's looking at a business, first thing you got to say is, who are these key people? And how do I make sure that they're more likely to stay, less likely to leave, and certainly not willing to go down the street and, work for my competitor?
That's exactly right. In fact, we're representing a husband and wife owner of about a $50 million business today. And they've got a key senior manager. And that's part of the discussion. And with the buyer, part of the negotiations on that deal is for that senior executive to some structure, and we're still negotiating that, to have some equity in the company as part of that retention, as well as probably a title increase and probably a base comp or a incentive structure increase, because he's key to the future. Because those owners, as most owners do, they anticipate transitioning out of the business at some point, and they know that for that buyer to be attractive to their business, there has to be a logical successor to one or both of them.
Yeah, no, we've done that. We've done phantom agreements where we want to keep, you didn't want to give stock to an employee that they now have to pay tax on. So either you got to pay the tax or they got to pay the tax, which they're not willing to do. So we've done that before through phantom stock arrangements where they're tied to the sale of the business. So they're incentivized to stay,
Exactly.
Because, at that level, look, when you're talking large corporations, public companies, sure, at the top of the pyramid, those people may be important, if they're very well known in the industry and you have top management. But at the end of the day, probably less of an issue if some employees went and tried to compete with this large company or went to a competitor, because the competitor's already big. You're already competing with them, right? But on the small level in the markets that we work in, it's huge. I mean, it really would blow up the deal. So how many acquisitions did you do for Macmillan?
Well, so over my entire career on the buy side, running private equity-backed companies doing leverage roll-ups, I've done right at 50 deals and spent a little over $500 million doing that. In the Macmillan deal, they ultimately went through a hostile takeover.
Okay.
And the three senior executives of Macmillan left and partnered with a huge private equity firm, Colbert Kravis Roberts.
Sure. Okay.
Started a new company, a holding company structure, and acquired the company that I worked for as part of that. So by the time, as I mentioned, we were about a $15 million business when Macmillan acquired us. 4 years later, we had grown to about 90 million.
Okay.
And that was around the early 1990s. And we sort of sat in a holding pattern for a couple of years, and then we really kicked it into gear. And we went from 90 million through the mid 1990s to about 300 million. And I stepped in as a CEO around that time, and we built the business to about 400 million.
Was it still in publishing?
It was in all diversified areas of media. So yeah, we had about 100 technical trade magazines. We had a technical book publishing division with about 300 titles. We had a trade show and conference business with probably doing 40 million of that 400 million. But that business was a money machine. It was about a 100 million EBITDA profit on a $400 million business. But a lot of that was driven by a combination of consolidation and efficiencies. Yeah. But also with every acquisition we did, we went through that diligence and integration process and identified best practices and incorporated those, which made, it was a 1 + 1 = 3 kind of a scenario every time you added on one of these new strategic businesses.
Yeah.
I was fortunate for 15 years. I worked for the chairman. He had been the chairman of Macmillan. Then the new company, he was a brilliant man. And he would always, when we go in for meetings in New York, he'd say, okay, tell us about this deal. And he'd always look at us and he'd say, guys, first, identify what they do right, because that's what you're buying them for. Because the logical assumption is we're going to buy you because we're going to fix
everything. Right. Sure.
Yeah, so
and there's some of that, right?
Yeah. But, there always is some of that.
Right.
But you're buying the business for its core value. And you have to figure out what that is and how to protect it at minimum and hopefully build on it in a bigger picture.
Yeah, I guess you can't just add gasoline to the fire. I mean, it's not enough. You got to know what you're doing. But it's interesting. So you were really in a larger corporate environment, but working on small businesses because they were
exactly right.
Units that didn't necessarily just add to one big company. They were all, I assume they still were operating independently for the most part, right? I mean, if they were in the same industry, maybe you merged them, but for the most part, they were independent business units.
Yeah, they were. So yeah, that company, I think we had at the end around a little over 2,000 employees. We had 23 divisional offices across the United States. And we had, we'd have a kind of a hierarchy structure. We'd have a division vice president, and we would aggregate strategic titles under that, but they each had their own operating group. But we had back office infrastructure, HR, technology, which is where you extract the efficiencies.
Yeah, that's where the efficiencies.
That's where you get the economies of scale. Especially back in the day when actual magazines were printed, you had tremendous volume discounts with the printers. The more titles you could push through their printing plants. So
the days of print brokers and stuff like that. Yeah, exactly.
Different world today for sure.
That's for sure.
That was a model. So it was called a leveraged roll-up business model.
So do you think that as a small business owner, so if you and I owned a company, let's say we're doing, 10 million in revenue, like a couple million of EBITDA, is acquisition a good strategy for growth? Because sometimes, growth is, or the organic growth in the early days may be very fast or, sustainable, but it doesn't stay at that level, depending on your industry, right? I mean, in order to scale, sometimes you can't scale because you don't have the systems, you don't have enough employees. You can't just start working on bringing in bigger customers and tripling because you don't have the people. So is that a viable strategy for small businesses to grow?
It is absolutely a viable strategy for small businesses, but it's somewhat dependent on what the goals and objectives are for that business owner.
Okay, good.
So I'll give you a real world story that we concluded negotiations last week, but I was working with the entrepreneurial owner of a very successful IT staffing and augmentation company.
Okay.
And he has approximately a 5-year goal where he wants to exit. And he's growing nicely via organic growth, but he would like to accelerate that process. And I happened to come across a small deal, because I knew his business, I could see that this could clearly be a compelling strategic tuck-in for him. I mean, he's 20 plus million in top line revenue and very profitable. This was probably about $1 million business, but it was in a pretty key strategic area, which would have enhanced his company, diversified it, but also there would be a mathematical play for him or a financial play on top of that as part of the acquisition, because there's a general axiom that smaller deals get a smaller multiple of profits or seller's discretionary earnings, and bigger deals get a bigger multiple. So
right.
For him, because this was a small deal, I'll make some hypothetical numbers, which are fairly accurate. Let's say he could buy that business for a 3-time multiple of that company's profits.
Okay.
Well, based on his size, he's going to get what's called an arbitrage on that multiple in his business, because once it's incorporated in his business, it's worth 5 times.
Right.
So again, it's a 1 + 1 = 3.
So they do these roll-up deals.
Yeah, it is a bit of a roll-up, but he had a 5-year time plan. So the return on that investment for him could be very compelling.
Yeah, sure. There's a lot of industries like that. So he was in the IT, like technology placement business, where they would place technology experts for whatever.
Yeah, so they're headhunters and what's called staffing augmentation, where they'll go to a major company and they will hire the employees themselves and place them in that company to do the work for that company.
Yeah, they're like leased employees type of thing. Well, they were temporary jobs, like.
Generally, some are if they're project based, but generally they're permanent jobs, and it's an attractive factor for the corporation that they're placing these employees in, because the corporation doesn't have to hire them and fire them and deal with the turnover. That's
right. It all gets done by them
on the augmentation company.
Yeah,
so it's a win-win. It's a win-win situation.
Got it. Yeah, no, I think that a lot of people are lost when it comes to, how do I grow my business? And I don't think that they really, and I hope people listening listen to what you just said, they don't really look at the other side of it. Okay, well, if I'm acquiring this business for 3 times its profits, let's assume, EBITDA's profits. We don't have to get into an argument about that with people. Sure. They'll get confused. So let's just say profits, right? So if it's a $500,000 profitable business, you spend $1.5 million for the business, whatever the terms are. But the larger company you now have, because you're doing, 4 or 5 million in profit, you can get a larger multiple. So it's not just that you add it and then you have more profit and then you 3 times it, but you can maybe get a 5, 6. I've seen higher multiples just because of the efficiencies of scale and running the business better. And sometimes you can even improve the profitability. So as a result of acquiring the company and improving the metrics, because you're able to do things on a larger scale that a smaller company can't do, right? Your EBITDA, your profit is higher, so you're getting a higher multiple of a higher number.
Exactly right.
So if I know math, like my wife, who's a math tutor, that's a bigger number at the end of the day, right?
It is certainly a bigger number at the end of the day. Yeah, that is correct.
What industries have you been working with? And I'm talking about Raincatcher, because we'll take a break in a few minutes for a commercial. But you're on the brokerage side now, M&A, investment banking, whatever you want to call it. But it's you're buying and selling, helping people buy businesses or sell in this case, right?
Yes, that's correct.
What kind of industries do you see a lot of movement in and sells and buys and acquisitions in today's environment?
Yeah. Well, a lot of people might suspect that in today's environment, there's not much activity based on interest rates, fears of recession, and
Right.
again, whether you agree or disagree with a lot of the change that's occurring in the political environment, that's
Sure.
not the relevant point. The fact of the matter is, change does it creates concern in people, and a lot of times they will kind of hold up. So we do see some of that. But our firm, Raincatcher, we're what's called a lower middle market firm. So most of our clients have companies that do between a million and 10 million in profits at the what we call
Yeah.
the EBITDA level.
Mm-hmm.
They're privately held, family owned, and they've reached a point in their life where this day and age they don't have children that want to move into their business. So that leaves them, it's this primary source of generational wealth for them. So
Sure.
they decide they need to sell.
Right. And their children don't want to do it. They don't want to be involved with the business, whatever it is, right?
Exactly. So we're affiliated with a FINRA registered broker dealer. So we meet all the national regulatory compliance requirements, and
Mm-hmm.
we represent business owners nationwide. So we can sell companies in all 50 states, Canada, and Mexico. We've had some Canadian clients for sure.
Mm-hmm.
But we're what's called industry agnostic. So we're doing deals. We've probably done a half dozen deals in the last year, and smaller SaaS platform software companies, digital marketing, media type businesses. We do a fair amount in construction industries. I've got 4 active deals in various parts of the construction industry, distribution, value-added distribution. One of the hottest categories overall where buyers are looking for deals, and by buyers, I'm saying independent, what are called independent sponsors or private equity firms or family offices, is in the broadly defined category of business services. So HVAC companies, plumbing companies, electrical companies, pest control companies.
The trades, basically.
Yeah, the trades, roofing replacement and repair.
Mm-hmm.
These are all businesses that have essentially entrepreneurial owners.
Mm-hmm.
Most often don't have family members or children want to move into their business, and they're aging out. You know, the statistic is 10,000 baby boomers turn age 65 every day.
Right.
So that there's a market for those, and a lot of those are being snatched up by these firms doing these leveraged roll-ups.
Yeah.
And they're also seen as quite recession resistant because if it's a new project or new construction, those can be impacted by economic factors, recessions, interest rates, etc. But there's always going to be the need for maintenance and repair.
Of course.
And a lot of these businesses have ongoing service contracts, so they have revolving revenue always coming in, which is very high margin.
Yeah.
So those are areas that are hot. But we're seeing deals on the consumer side of the business. As I mentioned, we do a fair number of staffing industry kind of deals, whether it's blue collar placement or high tech placement. Yeah, so and that's another area we're seeing fairly active interest from buyers. We're selling an accounting company right now, and I think we had an all-time record number of requests for information on the deal. We haven't signed a non-disclosure agreement, and it was off the charts. We almost couldn't handle the level of interest.
A smaller accounting firm?
Yeah. Because a lot of those are being rolled up by the much
larger. That industry. Unlike law, they opened that door up and said, non-accountants can own the firms now. So, Yeah. Well, exactly so you see them more on the private equity side. Those are more roll-ups, right? They're saying, hey, let's bring together all the dry cleaners, which I think is another big area of, it was ripe. Maybe it's less ripe due to pandemic. We don't wear as much dress clothes, but they're all small business owners. I've never, with very rare exception, I think there's like a Tide franchise out there.
Right.
That market is all small mom and pop shops.
Right.
And you bring in some good fundamentals and some good systems, and you roll them up for, like you said, smaller multiples because they're a tiny business. Next thing you know, you got a very large operation. And I think and the trades are a good example, but they're from the other companies you've worked with as examples too. A lot of these people don't really have exit strategies. Like I've gone to people and said, or I've been brought to people and said, listen, if you want to sell your business, first of all, you got to get your financials in shape. And that's right? One thing that people got to realize, if they're running their business as a lifestyle, they want to minimize their taxes, they want to maximize the money they have available, they may not be ready to sell because you might not be able to show anything. It's got to be on paper, right? It's got to be showing profits, and sometimes that involves paying tax. I mean, that's just the reality of things, right? And small business owners don't always do that. But also, I think that, sometimes people don't know what to do. Like, I have this, Cameron's my key guy, and maybe I can have him take over the business, but you don't have the wherewithal to do it. You're great at running the business, but buying it, taking it over, bringing in all the finances, you can't really do. So, I don't think people look at it that way, that they realize that there's a market out there that maybe they can participate in to exit from their business, assuming all the other pieces line up.
Yeah. So you just described a scenario that I see sometimes daily. So there's two kind of fundamental factors around this. And I used to teach a course for the Small Business Administration at a local college. And one of our sessions was completely focused on, if you're starting a company, if you're a young entrepreneurial business, or even if it's been around your second generation, you have to have an exit strategy in mind, because hey, the fact of the matter is, you're going to leave the business one day, one way.
Someday, you can't live forever.
You can choose to leave it standing up, or you can choose to leave it in a box.
Yep, that's true.
And so it's going to happen. So what is your strategy for that? And coupled with that is the other thing that we see, which would lead to asking that question and setting that strategy is, and it's just human nature. Conservatively, business owners spend 95% of their time working in their business,
right,
and only about 5% of their time working on their business. And to your point, Mitch, they do not understand that there's a significant difference between running a company for income or distributions at the end of the year, if they're a pass-through, S-corp legal entity,
right,
and to avoid taxes and maybe run some personal expenses through the business. There's a big difference between running a company on an operating basis like that versus running a company with an exit plan or an exit strategy in mind and a focus on value creation.
Right.
Because you're right, a lot of times they'll have to pay taxes, or the tough thing we see is if they're a pass-through legal entity, any money they don't spend on expenses goes into their pocket. But
and
if they're going to build, if they're going to build for a long-term exit, they have to invest into the business, and that means they're taking less of distribution today. And so many are just not willing to do that because they learn to live their lifestyle based on what they're taking out of the business. So those are some profound challenges that we see every single day in business owners who approach us and ask us about selling.
All right, let's take a quick commercial break for a minute or two, and then let's come back and talk more about that, because I'd like to talk about, what does a business owner do when they want to sell and they really haven't, it's a problem when you walk into a business and the financials are a mess and you're the broker and say, well, how do we clean this up to make this look good? And maybe it is a good business, but on paper it doesn't look good. So let's take a break. And I'd also like to know where you came up with the name Raincatcher. So it's for the acquiring minds want to know. So, all right, let's take a quick break, and then we'll come back. All right, let's do this. Maybe you're getting your calendaring from one software and you're invoicing from another. Evenoo is a platform that we use as one of our sponsors to run our entire business. And there's other features like auto payments and integrations with QuickBooks, social media marketing management, and funnels. So if you want to learn more about the tools that we use, visit evenoo.com, EVONUE.com to learn more. There's also a link in the show notes. And be sure to tell them that the Accidental Entrepreneur referred you. This podcast is brought to you by our affiliate sponsor, iEmployee. iEmployee is a virtual assistant service that hires almost anyone for any role in your company right out of the Philippines. Most roles range from $7 to $9 an hour for highly skilled and experienced VAs. And whether you need an executive assistant, social media manager, video editor, customer service, sales, you name it, they have it. We use iEmployee for our VA services, from editing and promoting the podcast to all the PR and promotion of our law firm. iEmployee acts as a virtual field supervisor,
on the back end with live video monitoring and reports on a daily basis with screenshots of your VA's workday, and along with complete HR and payroll duties. No more paying for overpriced and underqualified workers. There's a link in the show notes to get a 1-week free trial, and I encourage you to take advantage of it. All right, Cameron. So I think we're having a really good conversation for people that are listening, and maybe they're thinking about, well, what does the future of my business hold? How do I exit? What do I do? Like you said, you can leave standing up or in a box. That's pretty graphic but accurate depiction of things. First of all, so where'd you come up with the name Raincatcher? It's a great name, by the way.
Yeah, so Raincatcher's been in business for about 11 years now, so I didn't have any responsibility for choosing the name, but I understand the origination of it was the simple concept that it's easier to catch rain than it is to make rain.
Oh, okay, that's a good. Okay. That's a good answer. You're one of the partners, though, in Raincatcher now, right?
That's correct. Yeah, partner and managing director. Correct. Yes.
Got it. So, did you acquire Raincatcher, or did you just buy into the company, or what was that path?
No. I mentioned earlier on our broadcast here that I had done a very complicated turnaround and business transformation on a large nonprofit organization.
Yeah. Yep.
And that was under a 3-year contract, and that ended during COVID.
Mm-hmm.
And I'm a bit of an oddball, I guess, because I get bored very easily. And I had run companies for 35 plus years. And when you work for a private equity firm, sometimes that's a very high stress environment.
Right.
I decided I didn't want to go back to work running a company, and I had some opportunities to do that. I said, well, what else do I like to do? And I said, well, I like buying and selling companies. So I did my research to look at lower middle market investment banks around the country.
Mm-hmm.
And I found Raincatcher very early on in my research because it's a pretty digitally sophisticated business. Reached out to the owners at that time. And
you said in Denver, right? That's where they're located?
Yes, they're correct. Yeah, Denver.
Yeah.
And we began conversations. We hit it off. We were extremely well aligned on mission, vision, values, ethical standards, and that sort of thing. And over a period of months, we negotiated. And since I was actually the second to join the firm in that partner capacity, and so we have 5 partners now, one of whom, Jason Thomas, is one of the original founders, and he's the CEO of the firm. We've got about 16 team members. We've always been virtual, so we're located all across the country.
And you run like a professional partnership, you know, like a law firm or whatever. You're
exactly.
Partners.
Yes, that's exactly right.
Very good. Very good. Okay. So we were talking about, you know, I'm a business owner now, right? I have been running my business to support my lifestyle. Maybe I'm paying for, you know, a couple of car payments for my kids. Some of them work here, some of them don't, you know, vacations, all kinds of stuff. But when you, as the business broker, as the business, well, let's just broker for now, sure, come in, right? The guy who's going to help them sell the business, and you look at the financials, they don't look so good. They don't reflect the lifestyle that he's living. Well, maybe they do reflect the lifestyle he's living, right? And this guy hasn't taken his 5 or 7 or 10 years to, you know, kind of clean things up and run things differently. What do you say to him, and how do you help him?
Yeah. So I'll cut to that first. So there's 5 or 6 critical factors that we see in these businesses where the owners come to us.
Okay.
You've hit on the first one, which is the most critical, and that is around their financials.
Yeah.
Sometimes it's tragic how bad the financials are in these companies.
Yeah.
And the owners, I can't tell you, Mitch, how many business owners I've asked when they call us. We ask them, why do you think about selling?
Right.
And we'll go through that because that's a very personal part of it.
Of course.
Then, all right, give me a little bit about your business. What are your revenues? What are your profits? I cannot tell you how many business owners don't know those answers.
Yeah, that's frightening, isn't it? But it's so true. I know.
It is.
Yeah.
And I'll give you one true but really sad story. So we had a business owner contact me, husband and wife, wanted to sell a company in a high-tech area. They owned some patents, really good product. And we go through these questions and they say, okay, we're doing whatever it was, 6 or 7 million top line, and we're making about $1.5 million in profit.
All right. That's pretty
And
good.
I say, okay, well, after that, we say, here's what we can do for you. We sign an NDA for them. We ask them to send us all their financial information for a 3-year period and tax returns.
Sure.
One of the guys that works with me, Andy Henderson, he's out of Minneapolis. He's a licensed CPA and spent 15 years in audit practice with KPMG.
Okay.
And so he knows numbers.
He's looked at a few financial statements
and out.
Right.
So he will go through these with a fine-tooth comb.
Right.
And they weren't treating raw materials and inventory and work in progress properly.
Yeah, I see a lot of that
Once the
stuff.
accounting on his cursory level, not only was the business not making 1.5 million, but it was essentially break even.
Yeah.
And the owners were in shock. I mean,
Right.
it was sad. Really, these are really good people. I mean, we became friends with. We like them a lot. So
Right.
we had to refer them out to a specialized accounting firm, and they spent months and months reworking all of their financials. But that still didn't fix the core problem of
The core problem was it was a cash flow business, and they had no idea.
That's right.
That they were just living on cash flow.
That's right. And you're spot on, Mitch, because it was a very expensive product, and they would take a 50% deposit on signing a contract. Well, they were living on the cash flow of those deposits. It was essentially a revolving line of credit for them, effectively, without the interest rates from a bank.
Yeah.
So we see those kind of situations quite frequently.
Yeah.
And it makes a business not sellable.
Yeah, I think during COVID that happened to a lot of businesses, right? If their business dried up because their industry froze, all of a sudden the smoke cleared, and they're like, "Whoa, oh my God, we're not making any money," because they just went from one contract to the other, one deal to the other, would fill the hole and empty the hole, and fill the hole and empty the hole, and that hits a brick wall. And was that business salvageable?
Well, we stay in touch with them on a regular basis because, again, the product they manufacture is extremely high quality. And it's well differentiated and protected by a number of patents.
Yeah, which has value intrinsically themselves, but
right.
As an operational business.
Yeah, so if they can utilize proper accounting reporting to make smart business decisions and strategic moves, then ultimately they're going to have the value creation that I think they'll need to eventually exit the business.
Right. So we're talking about things like people treating things as expenses when they should be, inventory on balance sheets, depreciation and not depreciation, and it changes your financials. Just because you buy product, raw goods to make your product doesn't mean you get to expense $100,000 if it's a capital good, right? I mean, you're basically transferring cash to inventory, and that's going to change for people listening. Moving things from your P&L to your balance sheet changes a lot of stuff. It does. It might improve your shareholders' equity, but I don't know if that's, really does anything for a small business. As much as it changes just comes right off the profits.
Yeah. Well, sometimes depending on the situation, it can hurt them or help them.
It could help them. Right.
If it's a capital expenditure and they expensed it, and it should be on the balance sheet, then obviously that improves their bottom line, and that's helpful.
They might owe more taxes, but improves their profitability. Yeah,
exactly.
It's difficult.
Yeah. So the second thing we see that is a significant impediment to sellability, or for a company to sell at all, is what's referred to as owner dependency. So if the owner has no succession plan, no number two, he or she is a key customer contact, or they own all the knowledge, or if it's IP or technology, engineering,
it's all them.
It's all them. Buyers either discount the deal, change the deal structure to mitigate that risk, or they require that owner to stay on for an extended period of time, because they need that knowledge transfer, and that's usually inverse to what the owner wants, because when he or she is ready to sell, they're kind of thinking, well, I'll go through a 1-year or 2-year consulting deal, then I'll get out.
Yeah. No, we had a deal once where the owner was 94 years old, And it wasn't just him. I mean, it had multiple divisions and had key people, some of which they had to lock into the deal. Eventually, my people walked away from the deal because there was a huge risk if the business wasn't equipped well enough to run without him. So if he died, which became more likely when you're in your 90s than in your 80s, apparently, then you're going to have a problem. And there was no way to really mitigate that except, determine it as the buyer that, I can run this business. I don't need him. We walked away from the deal. Another group came in, and there was a bit of a real estate play in the deal too, but he didn't make it to closing. He died. And I don't remember if it blew up the deal, but it certainly changed the deal. I'll tell you that.
Yeah, it definitely would.
Because they didn't have the guy to answer questions. They're like, well, you ask questions. Well, who handles that? And who handles it? Oh, well, I do. Well, does anybody know how to do that? No, I know how to do it. I tell them how to do it. Well, that you should have been working on 20 years ago, Yeah. So, I think people listening should, can they, you use the term of working on your business, working in your business, the E-myth, right?
Right.
Can you go down the street and work in a different location for 2 weeks or a month and the business will still run itself, right? If you can't do that for 2 weeks, the business is way too dependent on you.
Exactly right.
And
That's
there are
actually
some
one of our
businesses.
litmus tests.
Is that a litmus test? It's a good test, right? I mean, it's like,
Yeah. We ask business owners, do you take vacation?
Yeah.
And that's a
I can't do that. I got to be plugged in. They got to know what's going on. Look, I've had businesses where there's a key person. They go, Cameron's our key guy. He runs the whole company. Okay, this is what we're going to do. We're going to send Cameron on a vacation for a month, and we're going to see how things go.
Exactly.
Don't do that when you're selling the company. Do it now. And I'm not saying Cameron's going to lose his job. He may become the president, but we got to figure out that everybody knows what the heck's going on. And there's especially small businesses in the area that you work, right? It's very common to be, you started the business, you had one assistant, she moved up, he moved up, and it's a very top heavy, type of codependent relationship. So you got to be, I'm surprised it's number 2, not number 1. It's the death knell for a lot of businesses. So you got to be able to answer that question. And I guess it's a question that you answer. Like, well, what if you're not here? Even if you sign a contract, even if the guy says, all right, I'll stay on for 5 years. What happens if he dies in a year? I mean, okay, maybe he's young enough, you get insurance, whatever. That's just money. But it doesn't pull data out of his head that you're trying to put together,
Yeah, exactly right.
Yeah. Okay.
And
you said there were 5, right?
Yeah. Next, number 3 is what we call customer concentration. So in this day and age, when we have buyers or interested parties that want to buy a business that we're representing, first question they ask is, why does the owner want to sell? How's their accounting look? And what is their level of customer concentration? And the litmus test is 20% of the business is the maximum amount of revenue that can be dependent on one customer. And most buyers walk at that point. If you tell them they're at 30% or 40%, or heaven knows, I've seen some 50, 60% dependent on one customer. And
then if you lose that customer, you're done. It's too much of a risk. I'm surprised it's 20%.
Yeah.
Here's 20%, you can have 5 customers. That's not enough.
Right. Here's a quick real life story on that very situation. I was representing the owner, very talented and creative owner of a small marketing agency. Mm-hmm. And he had a hospital chain with multiple locations as a key client. So he considered that, whatever it was, 15 or 20 different clients.
Right, but it was one hospital system.
It was one hospital chain, one brand.
Of course. Yeah.
And we brought him 6 offers for that business, all in the valuation range we had projected for him. But none of those 6 buyers would pay him cash up front as part of the deal structure.
Right.
And he got really angry about that. They wanted an earn-out. They were going to pay him a really handsome salary, but it was going to be a 3-year process, and they wanted him to stay on.
Because they want to mitigate their risk of loss.
Right. Yeah. And he turned down all 6 offers. And again, true story, 6 months later, the hospital chain left. And he had, at that stage, he had nothing that was sellable.
Yeah.
Great guy. I mean, a great guy. Really like him, respect him. But so that's a scenario with customer concentration.
Because the hospital system's not going to cancel a contract with one location. They manage. That's why they're a hospital system. They manage things from the top.
Yeah.
I think some people from this conversation have to reevaluate what they're doing and who their customers are, you know?
Well, I hope this is education, because this is
I
kind
hope
of
it's helpful. Yeah.
my mission and passion is to help owners with this. So next is vendor concentration. I had a client that was solely dependent on a raw material from one manufacturer. They didn't have a contract in place. And this owner's business, if that manufacturer said, yeah, I don't want to do business with you anymore, or I'm going to double my prices or what have you. Yeah, this business was out of business.
Yeah, and there wasn't a lot of alternatives.
No, and this was a great business. This was a money machine. But the risk factor for a buyer who's going to put their own equity in it, and a lot of times they'll bring in other equity, and then they're going to put a lot of debt on the business. It's high risk, and it wasn't a doable deal at the end of the day.
Because it's another factor that's beyond your control, right? You really can't control if your customers stay with you, especially if, like, a hospital system is a good example, right? Let's say merge two hospital systems. Now the people that you used to deal with are no longer there, and you're dealing with new people that have their people they want to deal with. Now you're in trouble. Or, like you said, the vendor gets acquired by a bigger organization that says, listen, I'm sorry, Cameron, your business is too small for us. We're not going to deal with you. We deal with much larger companies, or our pricing's different, or whatever. And it blows up it's another factor you can't control, right? You really have control over it.
Yep.
Yeah. So what do you do then? I understand the customer part. Okay, fine. You can look for new customers and build your customer base. But if you're in an industry that has, limited vendor relationships, so there, you buy, buttons for your shirt. And this is true, by the way, there's no American made button. There's no buttons that are made in the United States for shirts anymore. They're made overseas.
Right.
So now you're paying, the tariff is killing you. You got no alternative. So what does somebody do in those situations?
Yeah. Well, the example I cited, they just had one vendor. They had not sourced alternative vendors, which, as you've cited here, would have been overseas vendors. But still, that would have mitigated the risk if they were doing some business with one of these other vendors.
Yeah.
Just to show that there was more stability from a vendor dependency standpoint. The thing we're seeing, you mentioned tariffs. Every deal we look at, tariffs is a key buzzword. The buyers want to know how the selling company is being impacted by tariffs, and the selling company is in deep analysis around that. They're trying to do sort of forensic sourcing to go back and see where all of their raw materials are coming from. They're reviewing their contracts with their customers to make sure that they can actually pass along those increases that they're getting hit with from tariffs. And the buyers all want to see those contracts to understand that, to see that there's not going to be margin erosion in the business if the selling company has to eat those additional costs.
Sure.
Tariffs is a huge complicating issue for almost any kind of business today.
Yeah, I have clients that are looking at it on one side. Maybe we can get the materials from another country that has a lower tariff. Maybe they don't have zero. And then maybe we could pass on some of it to our customers, not too much. And then you meet it somewhere in the middle. But I think, that's going to obviously affect everything. So that was number 4, right? So what's 5?
So 5 is, on a broad level, is a general financial performance. So is their business stagnant? Is it declining? Is it growing?
Like from a revenue standpoint?
Yeah, from a top line revenue standpoint, obviously, does that flow through to the bottom line? But in particular, one of the metrics that we're being asked more and more about are what are that company's gross margins. And gross margins vary as a percentage of sales or of revenue by industry. So the key is to benchmark what the average gross revenue margins are for that particular industry.
Right.
And they should try to be at or better than those margins, and to be, it should be running in parallel with their revenue increases. And that's, again, an automatic out for a lot of buyers, because they have minimum thresholds for gross revenue margins as a percentage of sales. if they'll consider buying a business.
Yeah, of course.
So that means they have to be controlling and reviewing their raw materials, cost structure, or anything that goes into manufacturing the product outside of their selling, general, and administrative costs or other fixed overhead costs, which gets them down to net income or EBITDA.
All right. Well, I appreciate the conversation. You said more of the sell side, right? Almost exclusively sell side?
We're almost exclusively sell side, right.
Right. So you're going in and looking at these 5 factors and seeing if they stack up before you go to market.
Yep.
But yeah, I know we're coming up on an hour now, but I appreciate your comments. I think that when you start talking about M&A and mergers and acquisitions, it gets above everybody's head. But those 5 factors are very simple, right? Right. You just need to know, what my vulnerabilities of my business are if someone else were to step into my shoes, and that's what they're going to be looking at. So, that's what I would say. Well, what can blow this deal up? The fact that their vendor walks or, whatever, or the fact that they lose their biggest customer or, those types of things, or they're trending in the wrong direction. I think those are all helpful. So hopefully today people got some real world, good stuff to know that if they want to sell their business, they're looking towards that. Maybe they're not ready, which is good, right? They have time. Those are the things that they should focus on. So what's a good way for them to interact with you, connect with your company, especially if someday they want to sell?
Thanks. Yeah, so you can reach me by email at cameron.bishop@raincatcher.com.
Okay.
You can reach out to me on LinkedIn. Our company website is www.raincatcher.com.
Easy enough. Okay, we'll put links in the show notes to that. So again, I can't thank you enough. I'm glad it's sunny in Kansas City, and hopefully it'll be a couple of days to be sunny in New Jersey. And stick around for the credits. And I can't thank you enough.
Thank you. It's been great, Mitch. You're an excellent host.
In addition to being a podcast host, I'm also a small business attorney, mostly providing legal services in New York and New Jersey. With over 3 decades of experience, we can handle most transactional issues. So if you're watching the show and you encounter some sort of legal issue, reach out to us and visit our website, beinhakerlaw.com. Thanks for tuning into the show and for continuing to support us.